We started out in response to the bad news job data with a big rally in stocks, effectively pricing in an easier, more friendly Fed. But what quickly happened as we moved through the day is that you saw the stock market sell off and start to give back those gains. And this raises the question of when bad news is good news or bad news is bad news. And we think it's actually a fairly simple construct. When bad news comes out, it supports this idea that the Fed is going to be able to cut rates more. The difference of when it becomes bad versus good for risk assets is dependent on whether or not it challenges the current growth forecast. If the current data is challenging the growth forecast of 1.6% GDP growth for 2025 and 2026, as well as 12% EPS growth in 2026, then it's likely something that the market does not tolerate well. However, if the bad news is just suggestive of this muddle through growth and kind of consistent with the pace that we're going at, you don't see estimate cuts to growth, then it's something that the market can tolerate better. If the U.S. economy is running at a 30,000 effectively job addition run rate, is that consistent with 1.5 GDP growth? Is that consistent with 12% EPS growth in 2026?